You're missing out on multiplying your money by tenfold, and it's all because you don't want to learn the basics. But that stops today. We're going to be discussing the importance of why you should learn how to self-direct invest and ditch the traditional way of the banks managing your money for you. At the end, you'll have a clear understanding on what you have to do to get ahead of your finances. Self-directed investing means that you're taking full control of your investment decisions. You're researching, selecting, and managing your own portfolio. On the other hand, managed funds involve you entrusting your money to a professional portfolio manager or a team who makes investment decisions on your behalf. This is usually what traditional banks offer via their mutual funds. Have you ever gone to the bank and they sit you down in one of their back offices and start discussing your cash balance and how you can earn more by putting into their mutual fund? At that point, just get up, shake their hand, and leave. That's how I see it. These bank financial advisors are not your friends, and they are not looking out for what's best for you. The bottom line is they are selling you a product and they are getting compensated for it. One little tidbit I wanted to teach you guys is that whenever you're dealing with someone in business, you have to know who you're dealing with and what their motive is. What are they trying to gain from you in that transaction? Now let's weigh the pros and cons of each investing approach. With self-direct investing, you have the freedom to choose exactly where your money goes. You get to handpick your investments and tailor your portfolio to match your unique risk tolerance and investment goals. One of the major things that we will be discussing further is that you can enjoy lower fees when you're self-direct investing compared to having some managed mutual funds. However, self-directed investing requires time, knowledge, and discipline. You'll need to stay informed about market trends, conduct thorough research on potential investments, and actively stay on top of your portfolio. For some, this level of involvement can be empowering, but for others, it might feel a little bit overwhelming. But here's the thing, the payoff is worth it. The knowledge and skills you'll gain along the way are invaluable. However, with that being said, there are some dangers to this as well. Sometimes you can get off track of your self-directed investment journey, where you start investing in penny stocks, meme stocks, trying to get a quick profit. And usually with that, this is where the dark side of self-directed investment goes. This is where you hear the horror stories of individuals losing all their money, but that's where discipline comes into play. When you're learning about investing, I recommend that you put at least 25 to 30 hours into this, whether it's reading books, watching YouTube videos, or looking at articles online. Whichever way you prefer, you need to put in the time. Now let's talk about managed mutual funds. With these type of funds, you're tapping into the expertise of professionals or teams who have resources to conduct in-depth research, perform market analysis, and make strategic investment decisions on your behalf. However, the performance of these mutual funds are not always the best, and most often underperform index funds, but more on that later. Managed mutual funds give you access to a wide range of assets and strategies without having to actively manage them yourself. Plus, for busy individuals or for those lacking investment expertise, managed mutual funds provides a hands-off approach to growing your wealth. This might seem like a convenient option, but it comes with its fair share of drawbacks. For starters, you're entrusting your hard-earned money to someone else's judgment. But let's face it, nobody cares more about your financial success than you do. Now the most important thing, managed mutual funds often come with hefty management fees and other hidden costs that can eat into your returns over time. Why pay someone else to manage your money when you can do it yourself and keep more of your profits? Alright, here we have an article from money.ca and talks about how MERs, the management expense ratio, has an effect on your investments. So here they give an example of having $100,000 in a mutual fund, which charges a 2% MER. If you average 6% per year, after 25 years, you would end up paying $162,603 in fees. But now, say you invested the same 100K in a 6% return over 25 years, but the management expense ratio is 1%, then your fees would be reduced to $90,552. Even though we reduced it by 1%, you can see how much of a big difference it has in fees. But even with a 1% MER fund, $90,000 in fees is still a lot. So with these MER percentages, think about compound interest. You know how they say compound interest is your friend? Well, in this situation, when you're paying this amount, the compound interest is working against you. Alright, so we're going to use ChatGPT just to run a little scenario. We're going to use an investment of $10,000 at a 6% return and comparing a mutual fund that has a 2% MER with an index fund that you can purchase by self-direct investing that has a 0.10% MER. Also, it's going to be over a 20-year time frame. Alright, so with the calculation, you can see that with the mutual fund, your total returns at the end of 20 years is $32,071.35. But with the index ETF, it's $46,910.58. The difference is around $14,000. That might not seem as much, but when you're playing with bigger numbers, it adds up. Alright, so let's use $100,000 as an example. The same 6% return, we're going to use the same time frame of 20 years, and we're going to see what the difference is. So with the mutual fund, your total return after 20 years is $320,713.50. But with the index ETF 0.10% MER is $469,105.80. From that, you can see it's around $150,000 difference between the two investments, which is pretty material. So what's the best approach? It ultimately depends on your risk tolerance, time commitment, and investment knowledge. But personally, I believe self-directed investing is a superior choice. With self-directed investing, the power is in your hands. Successful self-directed investing requires patience, discipline, and a long-term perspective. Resist the temptation to make impulsive decisions based on short-term market fluctuations or emotional reactions. Instead, stick to your investment strategy, be diversified, stay focused on your goals, and trust in the power of compounding to grow your wealth over time. I'm also a strong advocate for self-directed investing because I've seen it firsthand, the incredible opportunities it can unlock. You can see my previous video where I revealed my entire 6-figure portfolio that I built over 4 years and see the results that I had. There is one thing I want to know that I read in Morgan Housel's Psychology of Money. In one of the beginning chapters, it mentions that no matter how much you try, you can't change someone's perspective on the way they think about their money. And it's because their life experiences with money is unique to them and much different than yours. And this hits close for me because I think of my older sister who have endlessly tried to teach money management by self-directed investing or even opening up an online bank account which offers a higher interest rate for savings than a traditional bank, which is a risk-free investment. But as the book mentioned, each individual has lived a different life. They have seen different things and experienced different times. As such, the way they perceive money could be totally opposite to you, which could be seen as crazy to you, but absolutely fine to them. My sister is 6 years older than me, and she was a firstborn child of 2 immigrants. She saw the struggles of the early days of my parents settling in that I didn't, and she probably saw the effects of the financial crisis and the impact it had on my family while I was in the 5th grade watching WWE. And for that reason, I no longer get upset with my sister when she doesn't want to listen to me in regard to her finances, as I know her brain is programmed differently than mine. All I can do is try to educate her, and that exactly is what I'm trying to do with you all. As you clicked on this video, I at least know that you're interested in investing. All I can do now is to provide you with knowledge and my experience to hopefully push you into starting your own investment journey. Thank you for tuning in today. I hope this video has provided valuable insights in self-directed investing and the comparison between managed mutual funds. The most important thing is to stay informed, stay disciplined, and stay focused on your long-term financial goals. I wish you guys the best. Until next time, stay locked in.